Start recording. Good afternoon, everyone, and apologies that we are a few minutes late, but I'm sure David will make up for that. We are delighted to have him here again this afternoon for the third session for the NFP balance sheet. Sorry, I can't get out of my words now. And yeah, as you know, we're recording the session. If you've got any questions, feel free to post them in the chat or when there is a natural pause or when David invites you for questions. David, over to you.
Thank you very much, Natalie, and apologies once again, folks. I promise I know more about balance sheets than I do about timekeeping, so hopefully you'll find it useful. As usual, I'll speak for about 35-40 minutes. Really happy to get some questions or comments. Happy to receive those as we go or to save them up till the end. And also always very happy to receive emails or other communications if you've got any queries. Today we're extending the discussion around balance sheets, and I find you can never talk enough about balance sheets. I'm sure all the accountants in the room would feel very confident in that respect as well. And we're going to look at it in the context of assets replacement. So we've already looked at the balance sheet itself in terms of the first presentation. We've looked at cash flow and solvency in terms of short-term arrangements. I want to talk about assets and asset replacement today, because I think at the end of the day, this is possibly one of the more challenging aspects of medium to longer term sustainability planning for not-for-profits and charities, for a whole heap of reasons, not least of which because, of course, charities don't have, generally speaking, a lot of money lying around for asset purchases. There's also not the tax and other effects that commercial organisations have, which make a big difference in both of our countries, Australia and New Zealand, but in most developed countries as well, in terms of the affordability of assets and how that impacts the financial reports going forward. And then the final point is, I guess, around the governance of those assets and how we might describe those assets, the kinds of things that directors and CEOs and others might be focused on to ensure that they are confident about the organisation's asset base going forward. So to that extent, I want to, as I say, talk about that balance sheet, but I want to remind everyone too that all of these presentations are based on the not-for-profit balance sheet, which is a resource for directors and CEOs for not-for-profits and charities, and which is available. I think Natalie's made it available to everyone previously, but certainly, again, either Natalie or I can send that to you. And it's really a non-country specific tool. It's designed to give you a set of questions and thought starters in relation to your organisation. I guess the other thing to just remember is, of course, every charity and not-for-profit is different. And not just in terms of what it does or where it operates, but also in terms of its size by turnover, its balance sheet asset base. And so my comments today are really very much focused on medium and large organisations, much less than small organisations. But I'm delighted to answer any questions in relation to those small organisations or to chat further about examples that might be relevant to people. So those war stories are really important if people are happy to tune in with those as well. They certainly help to educate me, but also help to position what I'm saying. So please think about that as we go through the presentation. So what's on my agenda? I guess basically I want to make some key comments that I think are relevant, and some of those are repetitive from previous presentations, but I think remain important because there's a contextualisation to the management of your balance sheet that is always critical to be kept in the minds of directors and CEOs and other stakeholders that have an interest in terms of decision making, in this case around assets. We'll have a look at asset replacement and forecasting, and we'll also be having a bit of a chat about the accounting aspects of asset replacement and assets themselves. And I know that most people in the room, I think most people in the room aren't accountants, so they're non-accounting specialists, but at the end of the day, the balance sheet is a critical tool in terms of sustainability going forward, but also understanding what it communicates to people when it's published. And so medium and large organisations often have obligations to provide financial reports to their stakeholders, including funders, but might also have obligations to publish those financial reports. Of course, the messages sent in the balance sheet mean a lot to those people that read them, and I think we need to be cognizant of that. So I wanted to make some comments around not just asset replacement in terms of how to think about it, how to go about it, but also how to think about or consider what kind of message you might be putting forward to all of those stakeholders and how they might interpret asset elements on the balance sheet. Again, I guess just finally, always happy to get other questions and comments about the balance sheet as well. So it doesn't just have to be in the context of the assets themselves. So key comments to contextualise. First and foremost, sustainability, of course, is the critical element. You might recall in the very first presentation looking at the balance sheet, I said that we were looking at sustainability of the organisation as being the driving force. But I think thinking about what that sustainability means is critical to also being able to decide what assets need to be replaced and when those assets might need to be replaced. So I posited in the last two seminars actually that sustainability for a not-for-profit or charitable organisation means that it continues to be able to provide the right services in the right quantity, at the right quality, and at the right time. So in other words, sustainability in my mind and the context in which my narrative today is focused is really around saying, well, a charity and a not-for-profit is not intended to remain alive and operating just for that charity's purposes. In commerce, we accept that companies need to operate and survive, and those companies, of course, are the raison d'etre. They're their own purpose, and stakeholders like shareholders enjoy the benefit of that. But from a not-for-profit charitable perspective, the corporation, in my mind, is a tool for the mission as opposed to being a raison d'etre in its own right, a purpose in its own right. And so to that extent, when I talk about sustainability and talk about replacing assets and the forecasting requirements in that regard, I'm talking about sustainability in the context of continuing to be able to provide the services or to execute on the mission as it's set out for your organisation. Just simply corporate survivorship is not really relevant to the discussion that I'm having. Now, some people might want to challenge that as well, and it's particularly important in the context of assets and asset replacement. But I wanted to let you know what the context is for me. At the end of that diatribe about what sustainability is, though, we need to think about two aspects. And last week we talked about this issue of sufficient cash, you'll recall, or last month rather, and looked at cash flow and what we might term sustainability in the short term, which broadly relates to solvency of the organisation, paying your bills as and when they fall due. The other thing I mentioned last week, though, and the week before in the context of sustainability, is being able to ensure that you have an appropriate asset mix to be able to support your mission going forward. What does that mean? It means that if you accept my contention that the corporate survivorship is not as important as the sustainability of mission, then the organisation has to continue to look at its asset base, what kinds of assets it has and how it deploys those assets in the context of that mission as well. Now, that has different implications for different types of charities and not-for-profit organisations, of course. Some not-for-profits, such as sporting organisations, really can be said to be set and forget asset purchases. So they might have a sporting ground, a change room and so on. It's very hard to imagine that that would become necessary to replace, other than the fact that it's worn out over time, because of course the utility is inherent in the asset itself. On the other hand, if you think about aged care or disability services, or some of those other human services that require not just staffing and carers to be able to execute the mission on, but also require specific assets that might be constrained by government regulation, that might have some requirements in terms of how they're formatted. And in Australia, for instance, in the aged care sector, the Commonwealth Government, which manages this sector and funds this sector, also publishes its expectations for aged care facilities, their design, their style, how they're developed 10 years in advance, so that people know that if they build a new aged care facility, for instance, they need to build it in the style that's required coming up as opposed to in the current style. But they also might need to be looking at those assets in the context of replacement in terms of whether or not they need to replace like for like, or whether they have to replace an asset that might look somewhat different in the future as a result of that government regulation or other regulation. I guess what I'm trying to say here is that the appropriate asset mix needs to be understood in contemporary terms and also in future terms for those organisations that have major physical asset bases because they provide physical services, if you like, such as accommodation and so on. We'll talk a little bit more about that as we go through the presentation. You'll be delighted to know. Okay, the other thing that's important is just positioning the asset replacement process and considering assets in the balance sheet. And you'll recall from the last two presentations that I mentioned or set up the time process or the temporal process in the context of this discussion in three broad terms: short term, the mid term, and the longer term. Typically in accounting, when we think about short term, we think about the next 12 months, so current assets and current liabilities, for instance. In the mid term, we're talking, in my mind, 3 to 5 years, and in the longer term, we're talking about 3 years and over, so into that longer term period, and looking at the organisation in that regard. You'll recall from previous presentations that in the short term, we're really worried about cash flow and working capital, and that was the subject of our discussion last month. In the midterm, we're also worried about things like leave entitlements and depreciation estimates, so that sustainability impact in the medium term and how we continue to be able to provide the services that we need to provide. We generally talk about the long term being that asset replacement process. Now, in that respect, I think it's important to remember too that in temporal terms, of course, the longer we survive and the longer we operate, the quicker that longer term becomes the short term. In other words, that one of the things that we've talked about consistently throughout these presentations is the fact that we have to have not just an annual budget process and considering our budget against the, or rather our actual outcome against our budget, but we also need to have a financial plan of 3 to 5 years in order to be able to drive what we're doing. And that includes forecasting asset replacement, not just what needs to be replaced, but what is it likely to cost and what is the, where is the cash going to come from? So to that extent, short, medium and long term are absolutely critical, but I need you to be aware, of course, that that long term creeps up on us and it becomes more and more critical to replace those assets as the long term becomes the short term with the inflection of time. That also, I guess, is taken over in or considered in the context of governance in this particular discussion. And again, you'll recall that in terms of governance, we talk about that financial planning process in 3 temporal modes of short, medium and long term, but also in terms of what we might do each year to make that work. In the context of asset replacement or asset management, of course, we're looking at the annual capital budget for the organisation and understanding what needs to be done on an annual basis to be able to build that cash flow requirement and understand how things might move forward in terms of the financial plan. In terms of ongoing development, one of the things that I think is really critical is that organisations develop an asset reinvestment plan. And I'll speak to that a little bit more deeply in terms of how you might forecast when assets are going to become redundant, when they need to be replaced. But at the end of the day, an asset reinvestment plan is a plan that simply looks at each asset that the organisation holds, usually over a materiality level. So for instance, you might not be concerned about one car in a fleet of hundreds of cars, but you might be concerned about buildings, land, or other more substantial assets. Obviously, materiality is relevant to the organisation, but that reinvestment plan looks at 2 things fundamentally. One is, well, what are the assets that we need to be planning for in the short, medium, and long term in terms of replacement? And 2, where does the cash come from to be able to achieve that? Now, in that respect, the development of the financial plan is really about trying to forecast your cash requirements over that extended 3 to 5 year period. And if we are developing an asset reinvestment plan, we need to then be able to see what the gaps in cash might be in order to be able to plan where that gap might be filled. And that gap might be filled from government grants, it might be filled from philanthropy, it might be filled from profits associated with the organisation. And again, last month we talked about profitability and the importance of profitability in charities. But the asset reinvestment plan doesn't just talk about replacement of assets, of course, it talks about any capital maintenance or capital change that is required in terms of those assets too. So if I go back to my aged care facility example, I mentioned that in the Australian context, the Commonwealth Government sets out the design requirements for those facilities 10 years in advance in order for people to be able to prepare themselves to be able to either replace the assets with a whole new asset that meets those requirements, or to convert current assets to be able to maintain and enhance those current assets to meet those requirements going forward. Of course, there's two decisions that boards need to make there. The first one is whether or not it's more financially appropriate to simply bulldoze an asset and start again, as opposed to spending money or throwing good money after bad on an asset that might not ultimately be serviceable. But the other aspect is, of course, where that money is coming from. And I think that's the critical question that boards need to be asking as soon as possible in order to be able to meet those demands in 3 to 5 years' time. So in terms of the financial plan, the asset reinvestment plan feeds into that to give us a sense of what the capital requirements of the organisation are going to be. The other thing, just touching again on last month's presentation in relation to cash flow, reserves are also really important to consider here, because if you have a 5-year plan and you identify that you need to replace an asset for an estimated amount at the end of that 5 years, then you'll be building a cash balance in your balance sheet that needs to be explained to stakeholders and others. In other words, you need to be cognizant not just of internal planning requirements and the fact that you're putting cash aside, but also the fact that, as I mentioned in my prefatory remarks, readers of balance sheets are going to be looking at all of the items on the balance sheet and asking questions. And one of those questions will be, well, why do I continue to provide funds as a philanthropist or funder if you've got funds sitting on your balance sheet? You need to have a narrative around that, a communication around that, to explain what it is you're doing and why you're doing it. And you never know, that might also attract funders to be able to support you in your objective for replacing a particular capital asset. The other thing to think about then is that financial plan, as I mentioned before, and how you are updating that financial plan on an annual basis. So when we think about assets and their management, we need to have an iterative process in place to continually revisit those assets and to make sure that the board and the CEO and others are comfortable within the governance structure of the organisation. But we tend not to do that on a monthly basis. We tend to do it iteratively, perhaps once or twice a year, in order to look at those values and to update that financial plan accordingly. It might be triggered, as I said before, by changing government arrangements or government requirements in terms of facilities and the attributes of those facilities, or it might be triggered by something else that happens, which we'll have a look at shortly in terms of asset replacement triggers that you might consider. At the end of the day, the financial plan doesn't need to be looked at on a monthly basis by the board, but it does need to be looked at iteratively. And it may well be that if you think about it, looking at the financial plan at the half year and full year position might be a very logical and time effective way for the board to be able to go forward. If that's the case, of course, looking at that financial plan means you need to think about the capital assets of the organisation in that context, both in terms of valuation and replacement, in order to inform the financial plan and to update it. The other thing always to remember, and I always feel I have to keep saying this because I think things creep up on people, of course, but that 5-year horizon quickly becomes next year. And in that case, we need to be across how those assets are creeping up, or asset replacement decisions are creeping up on the board, and making sure the board is attuned to that process as well. So in terms of timing and asset mix requirements, as I mentioned before, the regulatory arrangement is something that needs to be taken into consideration. The changing technology might also be something that needs to be taken into consideration, not just from an IT perspective, but there might be technology from a clinical equipment perspective or other perspectives that make a difference, particularly in care environments where health and safety and tools to support carers are really important to maintain staff safety and prevent injuries. The other thing that might be important, of course, to consider is changing consumer demand. And while funding predominantly for human services comes from government sources, and those government sources effectively create the demand and nominate what that funding is to be provided for, of course, consumers have a sense of what it is they want, and you need to be responsive to those people. And of course, that might mean that there's a substantive change in the way people perceive the use of assets or facilities in terms of their utilisation. For instance, I keep picking on the Australian aged care environment, but I think it's a good environment, a good example. While government might set specific standards for buildings in aged care facilities, at the end of the day, you might enhance those standards or go beyond the requirements of those standards in order to meet consumer demand, depending on where a aged care facility is located, and perhaps even depending on the capacity of people to pay as part of your sustainability drive going forward. So changing consumer demand should also drive your thinking in relation to asset replacement and asset management. And as I mentioned before, that ongoing sustainability development is absolutely critical. In terms of asset management, though, it might be critical where you're thinking about not just the asset mix and in terms of the services you provide at the moment, but you might find that there's also a third decision that you might make in relation to asset replacement. I mentioned before, typical decisions are whether you simply replace the asset, fold it over and start again, whether you enhance the asset by undertaking capital maintenance works to be able to bring it into line with future regulatory or consumer requirements. The third option might be that you actually don't provide those services anymore. And that's a really important thing to consider in the context of where the financial resources of the organisation are likely to be and what the asset mix is likely to be needed in order to continue to provide that service. Now, that to some extent might be argued to go contrary to my discussion around sustainability, but where you're providing different services, such as conglomerate of services, it might be that you might narrow the service provision in order to, for want of a better phrase, stick to the knitting, stick to the things that you're really good at. And part of the asset replacement impost on the organisation might help you to make those kinds of decisions. Certainly, again, I keep picking on the Australian context, and I hope the examples are useful. But one of the things we are finding in terms of charitable services, human services sustainability, is that those organisations that are reducing the number of services they offer and focusing to become specialists in specific services are apparently more sustainable than those services that are conglomerate and that have many different service undertakings. So the asset replacement decision can't be made, in my view, just simply based on business as usual. You need to think about it in the context of what ultimately might mean financial sustainability for the whole organisation and the whole portfolio of services that you're taking forward. Forecast timing, of course, is also really important. One of the realities, not just in the not-for-profit charitable sector, but in the commercial sector, is that directors have a penchant for delaying and pushing back on asset replacement. And they do that for obvious reasons. It takes a lot of capital in the commercial world. It can impact dividends and things like that, which is not a very attractive thing for a lot of shareholders. But in the not-for-profit and charitable sector, it might simply be that there's not sufficient funds, or that we're delaying decisions about our service mix and whether or not we continue to provide particular services. So that forecasting timing is really critical. Not only for being able to identify when money might be available, but also making sure that you have the discipline to undertake that asset replacement. I'll get to that shortly. But of course, you don't want to be caught with assets that don't work or that are unable to be deployed without thinking about how those are going to be replaced or being able to respond to that situation. The final point that I want to make here is about depreciation. And depreciation I'll talk to in just a second, but one of the things that I think is really important for organisations to consider is the amount of depreciation that they charge in their financial reports on an annual basis, and whether or not they recover that depreciation in relation to the financial performance of the organisation. And the value of assets, of course, impacts that depreciation charge that might be made, and the timing over which those assets are replaced also impacts that charge. I guess there's two things here that are important. One is, are you actually performing financially sustainably enough to be able to recover the depreciation charge against your accounts? And secondly, what is the impact of depreciation when you replace assets? In other words, what impact does that have to your apparent financial sustainability from your stakeholders' perspective when they're reading the profit and loss going forward? I guess what I'm saying here is that if you replace one asset that's written down that is relatively insignificant on your balance sheet because it has been worn out effectively and is being replaced with another asset that is very expensive, the concomitant depreciation costs impact your financial performance as well, and you need to think about that going forward. So what is depreciation? Well, I'm glad you asked. Most people are always fascinated by depreciation discussions, and particularly by the definition of depreciation, which I think is a really important thing for people to be across. Often people think about depreciation as being, in one sense, an accounting entry that really no one cares about. And even in commerce, a lot of companies report on their profit before depreciation because the perception is depreciation doesn't matter. The other thing that you often hear, particularly in the not-for-profit and charity sector, is that depreciation really is setting aside money for the replacement of the assets. And so if we can charge it, that's great. If we get cash flow or profit after depreciation, that's great, but it doesn't really matter. I know profitability has two problems in the not-for-profit charitable sector in the Anglophone world. The first one is not-for-profits and charities don't like to talk about being profitable because there are stakeholder and other implications to that. But I think that one really is something that we need to think about, because profitability is critical for any organisation operating in a mixed market economy. You have to be profitable, and we need to educate our stakeholders accordingly. Traditionally, though, you should be profitable after depreciation. And as you can see here, depreciation really represents the estimate of the rate of consumption of that asset. If you are a board that is concerned about planning for asset replacement, having a 5-year financial plan and looking at that financial plan diligently in terms of what the replacement cycle might be, then depreciation is your best estimate of the consumption of that asset. Thinking about how you apply that depreciation, how you calculate it, and what charge you put to your profit and loss each year is a really critical element in the planning process, because technically, by the time the asset's fully depreciated, you should have arrived at your asset replacement point in time. In other words, it helps you to be able to understand when that asset's likely to be replaced. Now, like all decisions, there's flexibility in that. And I mentioned before the penchant, both in commerce and in not-for-profit organisations, for directors to delay and push back that decision. And that's fine. But I think you really need to have a discussion around board tables about what depreciation means for your organisation and how it can assist you in making the decisions you need to make for asset replacement. The other aspect of depreciation that's important is the valuation process for assets. And this can be really a sticking point for not-for-profits and charities, as well as for government. It's a sticking point because there's often not a market for the assets that might be retained, but also because, as per our discussion in the first lecture in this series, assets might not be able to be fungible. And fungible is a really nice finance word that means can't be turned into cash. In other words, you can't just go and sell that asset and make money out of it, because it might have been provided by a funder or government, and that government or those funders might have provided the asset on the proviso that there are constraints around how you might use it or how you might realise it. The other thing about valuation is that there are assets, of course, that charities and not-for-profit organisations own that are simply not susceptible to valuation because a market simply doesn't exist. Things like churches, in the case of religious charities, are really good examples here. But so too are a lot of purpose-built facilities or crown land that might be provided to a charity or not-for-profit organisation upon which an asset is built in order to be able to provide services. It's important, as much as I don't want to talk about accounting standards in this environment, it's important to remember that all of those types of assets, regardless of whether they're restricted or not, meet the definition of assets in the context of accounting standards. What we need to consider is not just the estimate of that rate of consumption for the asset, but also what the value of that asset is over time. And that might mean that the asset is valued initially at what we call historical costs, so how much we paid for it, but also on an iterative basis. At least once a year, directors should look at the material assets in their organisation and determine whether or not those assets are valued correctly. You might use your insurance to valuation to be able to help you to arrive at a value, or you might have a valuer come in every 2 or 3 years to look at buildings or land or other assets that you might be carrying in order to be able to get a better valuation that you might have had up to that point in time. I guess the purpose of the valuation process is twofold. One, to be able to report effectively to your stakeholders, which of course is important. And that includes that the auditors are going to be comfortable with the valuation that's in the balance sheet. But also it allows you to appreciate what the replacement value of that asset might be at the end of your 5-year plan, or that time in the future when you know your asset is going to be exhausted and you're going to need to replace it. And that's another thing that can creep up on directors, again, both in commerce and not-for-profit organisations, where they hold an asset value on a balance sheet that after 5 years' time really doesn't reflect the true value. So typically, directors look at the value of assets, then they look at the depreciation being charged on those assets in order to consider the timing of the replacement of those assets. And as I said before, probably annually is a good time to look at that, perhaps leading up to the audit or the annual balance date, in order to be able to support the balance sheet that's going to be published for the organisation going forward. When will it be exhausted is also a really important issue, and I'll come to that shortly. But I think that's obviously an important thing to be thinking about. And what does exhaustion look like from your organisation's perspective? When it's unsafe, when it's uncompliant, as I said with regulation before, when it's unserviceable, of course that's important, and perhaps when it's superseded from a technological perspective. Let's have a look at what that might look like. So asset replacement, as I mentioned, is part of that financial planning process, part of that short, medium and long-term process. It's about where does the cash come from and how do we determine how we're going to balance that out. I guess one of the things having a financial plan that is really comforting for funders and other stakeholders in your organisation is the fact that you would appear that you're organised and that you understand what your cash flow requirements are, but it also can mean that you can help philanthropists and others plan their cash flow in subsequent years to be able to support you for your assets. From a philanthropy perspective, that's a much more attractive outcome than being asked 5 minutes before an asset needs to be dealt with. But it also shows to that philanthropist that your board and your organisation understands your balance sheet and understands how to manage your assets going forward. The lack of resources may drive that decision making, and I think that's absolutely understandable. I mentioned before that boards often push back asset replacements because they don't want to spend the cash or because the cash is not available to them. I think that that's appropriate, providing the board acknowledges and respects that it's actually making that decision, I guess, from an intellectual basis of understanding what the risks and rewards might be in that regard. In other words, being able to articulate what's driving that decision making and the fact that there's a risk inherent in not actually replacing that asset during the planned time. So that 5-year horizon is absolutely critical, and I want to speak to that a little bit more now in the context of that asset replacement. Okay. When you're thinking about an asset replacement decision, I think it's really important for organisations to have a set of principles that they work to. And those principles, of course, should be prioritised according to the extent to which they are considered to be important from the director's perspective, and also prioritised in the context of what kind of potential risk or impact might occur if those assets fail. And here's 5 principles that I think are really important for directors and officers of not-for-profit charitable organisations to consider when you are looking at particular assets and when you're trying to forecast when those assets might need to be replaced. You can see here that those principles start off with unserviceability, or assets that are unserviceable, assets that can no longer be used and sustainability is negatively impacted by your organisation accordingly. So you need to establish a serviceability minimum in relation to all of your assets. So for motor vehicles, often based on the turnover value, the recycle value of motor vehicles, organisations have 2 years or 14,000 kilometres or whatever it happens to be that's most appropriate from a financial perspective in terms of their organisation. In other words, that unserviceability might relate to the financial outcome just as much as it relates to the actual deployment of that asset. I guess the other aspect of that is that those 5 principles that you can see enunciated there are also to some degree interrelated. So an unserviceable asset might not worry you because you've got a fleet of 100 cars, and one car that's not able to be used doesn't really make much of a difference to the organisation. On the other hand, unserviceability might be a really key issue where you've got assets that might sustain life or support carers in doing the work that they do. And the advent of an unserviceable outcome on one of those assets might be absolutely critical. And that feeds into that next replacement principle that I've got there, which is unreliability. Unexpected and sudden reduction in utility of asset causing a lost capacity might have an impact heightened when there are unpredicted failures. In other words, what are the assets? What's the nature of the assets? And if they fail in an unpredicted way, what kind of impact does that have? I guess from a governance perspective, you can see there that I'm making suggestions about how you might react to this. In the context of unserviceability, I'm saying, well, have an established serviceability minimum. And as I've said before with a car's motor vehicle time, owned or kilometres might be minimum. In terms of unreliability, age limits might be appropriate minimum. So where you have motor vehicles, again, obviously the older the vehicle gets, the less reliable it becomes, as we know. There might be an impact, though, for your organisation in the context of loss of accreditation. If an asset no longer meets the standards, or if unreliability or unserviceability impacts your accreditation, then there is a replacement issue that's required to be considered there as well. And so, for instance, one governance outfit there or outcome there might be that the organisation maintains accreditation assessments for all of its assessable assets in that regard. Is the nursing home inspected once a year, or the aged care facility, the disability service facility, inspected once a year for compliance against the requirements of the funder, for instance? The other element might be loss of applicability. And you recall that I talked to the issue of a situation where consumers or others change the type of services that are required or impact the way you deliver those services. And so you might see that not only is a funder changing their policies and attributes for particular services, but if your asset is no longer relevant to the application of that service or the provision of the service, then you need to, of course, be monitoring those elements, because you're holding assets that are not able to be fungible, perhaps, or not able to be turned into cash, and assets that may not, in the longer term, be able to be viably replaced or viably maintained. In other words, in terms of that loss of applicability, being able to forecast when your assets are no longer going to have utility for you is really critical, because that might bring forward realisation dates for those assets as well, where you can sell them into a market that still exists, as opposed to trying to sell them into a market at some point down the track that doesn't exist and which reduces the outcome financially for your organisation. The final attribute or replacement principle there is in the context of high risk assets. And as you can see there, I'm suggesting that those kinds of assets might result in or failure of these assets might result in the impact on health and safety for staff or clients. Clearly, those high risk assets need to be thought through absolutely fundamentally, and it might be that you maintain time schedules and simply replace those assets regardless of whether they work or not. I know this is probably stretching the bow a little bit in terms of examples, but over here in Perth, where I am, BHP has a very big smelting facility, as you can imagine. And one of my friends is a maintenance supervisor there. And fundamentally, there are a whole heap of valves and other pieces of machinery that simply get swapped out every 6 months. It doesn't matter if they're in good condition or bad condition. It doesn't matter what the issue or lack of issues might be surrounding those particular items. But for safety's sake, those things are replaced, because it's absolutely critical to ensure that there's no failure in those particular parts of the machinery. Of course, the same thing happens in relation to care services and support equipment or other equipment. It might have an impact on the health of staff or clients, and which might mean that you actually have a dead, what we might call a drop dead horizon on the life of assets, and you replace those assets regardless of the outcome. I'd go through and have a look at those in the context of your organisation, the kinds of assets that you have, and just remembering that those replacement principles are intertwined. So there might be more than one principle that hits the mark for your assets and how you consider them in terms of manage them. As I said before, those cash reserves also become a really important issue. And remember those issues from last week where we talked about maintaining those cash reserves, understanding how much is enough, but also communicating and making sure that those cash reserves are being dealt with properly in terms of reporting to your stakeholders. Again, presentation 2 dealt with that, so please go back to that. And I think Natalie's certainly got a copy of those slides, and I've got the presentation as well if you would like them. Let's get to the bit. I always come up to a crescendo to include the accounting issues right at the end, because I know that's the exciting bit that everyone really wants to be thinking about. But there are accounting issues with this as well. And again, for that auditing process, as well as for the message that's provided to stakeholders around asset management, I think these are really important things to consider. I've only touched on them very slightly, but remembering that when you realise an asset, there is a profit on sale or a loss on sale that will be brought to your profit and loss if you're a medium or large charity or not-for-profit organisation. In other words, it will affect the profit of the organisation and how you communicate that profit. And therefore, you need to have a narrative around what the cash flow effect of that sale might have been and how you've arrived at that profit or loss is a really critical element there. The other thing to be thinking about in that context is also the depreciation estimate, as I mentioned before. That will impact the profit and loss, and therefore you need to have a narrative surrounding that particular aspect of the accounting process as well. Valuation, timing and utility, I've already mentioned that you should be looking at the value of your material assets, and material assets are those ones that are really driving the balance sheet and the substantial assets of the organisation. But remembering materiality might relate to size and cost, but it might also relate to the impact of failure of that asset on the ability of the organisation to pursue its mission. So it's not just about size and cost, it's also about mission impact as well. All right, I've sped up a little bit because I know we're getting out of time. I'm sorry again that I did start late, but I'd be delighted to take questions or comments. And as I said before, very happy for people to email me if you've got any thing you would like me to cover off. Phew, thanks, Natalie.
Thank you, David. Yeah, we'll open up the floor if anyone has got any questions they would like to ask. Now's the time to do it. Yeah, there's a question here from Fiona. Hi, David. Can you talk a bit about a revaluation reserve? Sorry.
Oh, I can. Hi, Fiona. How are you going? Revaluation reserve. I love an accounting question. Thank you so much. There's in accounting, there's 2 types of reserves, and in the last presentation 2, we talked about cash reserves, what I might call physical reserves, where you're actually collecting cash for a particular purpose and you put that aside, and it might be to support your employee entitlements being paid out, or it might be to buy a new hospital or whatever. That's one type of reserve. The other type of reserve is a balance sheet reserve that's an accounting reserve, and the asset replacement reserve, or revaluation reserve rather, is just such a reserve. It's if you like, the corresponding entry that goes to the increase or decrease in the value of the asset itself. And it helps us to understand in accounting terms how much movement we're entitled to in the context of that particular asset. Now, this won't apply to most people, but you do need to consider it. When you have an asset revalued, so you get to that point in the year where the directors sit and look at all the assets, and you determine that, I don't know, the house that you currently hold in a suburb out of which you provide services, the housing market has gone through the roof, so you need to revalue that asset. There's an implication there from an accounting perspective. If you revalue the asset up, then you're not allowed to, generally speaking, in international financial reporting standards, report the profit on that asset revaluation. You must actually put that profit to the asset revaluation reserve on the balance sheet. Why is that? It's because, of course, changing the value of assets can be substantiated by directors who would then increase the value of the profit that they're reporting. So predominantly this is aimed at commercial people who might be incentivized under any other arrangement to increase their profit simply by increasing the value of their assets. If you decrease the value of your asset though, you bring that to the profit and loss as a loss to the organisation. In other words, you report the losses, but you don't report the profits, which might seem a bit strange, but if you have an asset revaluation reserve, you're entitled to place any losses against assets to that reserve. In other words, reducing the reserve. So it's a technical accounting process, but that does impact your profit and loss and how you report that. If you have an asset revaluation reserve on the balance sheet already, it means that any future reduction in asset values are not going to impact the profit reported by the organisation, providing there's sufficient reserve there to do that. Happy to chat further, Fiona, too, of course.
A follow-up question is, and so what happens to the reserve when you sell the asset? Another great question.
Another great question. I'm loving the accounting questions, and I'm just having my first coffee for the day too. So I'm struggling through it all, but it's great to have accounting questions. The asset revaluation reserve sits on your balance sheet, and that will be adjusted by increases in values of assets and decreases in values of assets. When the asset is sold, there's two things that happen. In terms of the asset revaluation reserve, no adjustment is made there because you hold that reserve. When you sell an asset, you sell it at a loss or at a profit, and you calculate that loss or profit by taking away from the the sell price of the asset, the depreciated value of the asset. And then that becomes the profit or loss that is reported in the profit and loss report. So the asset revaluation reserve can't be reduced or increased by the profit that is related to the sale of asset. It is simply for adjustments to the valuation of those assets. The profit or loss must be reported in the profit and loss report according to international accounting standards.
Cool. That was a thumbs up from Fiona, especially because they're from a physio. She added to a previous question.
I've said to Fiona before that she should be an accountant. It's a really important thing.
Thanks, David. Does anyone else have any questions? We're happy to answer. We've got a few more minutes. Well, David probably has another hour because he thought we weren't happening until an hour.
I might have breakfast.
That's always.
I've only got a collared shirt on. I've got my pajama bottoms on. I've got to get ready for work. Donna, have you got a question? No.
I'm just waving out to you.
Nice. Yeah, I think there might be a few other people who were confused about the time because we've just added Dawn into the waiting room. If nobody has any more questions,